Today's webinar, what we wanted to discuss was value investing in the current markets. There's been a lot of uncertainty and fear in the markets recently. Interest rates have gone down quite a bit. Market and equity prices have gone down quite a bit as well. Stay the course with your investments or potentially make some changes if they're warranted, and how you can potentially take advantage of some opportunities that are in today's market. So those of you who aren't as familiar with our company, the Retirement Group's an independent financial planning organization that specializes in helping corporate employees plan for and transition into retirement. We manage retirement assets for individuals that are retired from Fortune 500 companies. And we have a very specific approach and philosophy that we're going to talk about tonight that hopefully you come out of this discussion with some food for thought in how to approach the current environment in the economy, as it's been one that we've never really seen anything like before. But we want to hopefully give you some optimism and some ideas to be able to take forward in your retirement plans and in your investment portfolio. So for tonight's agenda, first we want to talk about why we actually invest money, inflation, and how that affects our investments. We're going to talk about the Retirement Group's investment philosophy as it pertains to modern portfolio theory and margin of safety. We're going to talk a little bit about emotions, how they can unfortunately make us have some decision making that might not be in our long-term best interests, as well as how we can take advantage of opportunities that exist because of the emotions of other participants in the market. And we'll talk about ways that we can capitalize on today's opportunities, some very unique advantages and opportunities that we have today, and next steps, how we can help you at the Retirement Group today. So we always look at inflation because one of the reasons we need to invest money is to keep up with rising costs. Think about it, you retire today, you could potentially have 30 or 40 years that you need your money to last. And the further along we go, the more expensive goods and services become. So one of the reasons we need to invest money is just to keep up with this rising cost of living, especially as a retiree. Healthcare becomes an incredibly rapidly growing cost as a total of our budget, not just in how much we're spending on healthcare and medical costs, but the price of medical costs as we get older and older. Now, if we were to have all of our money in safe asset classes such as cash or CDs would be another potentially safe asset class. Unfortunately, we're going to see our purchasing power deteriorate if we're not at least keeping up with inflation, which recently has been relatively low. But on average, we think that we want to get somewhere around 2.5% to 3% just to keep up with cost of living over time. Now, of course, that could change. Inflation could become higher over time, and the higher inflation becomes, the more important it is for us to have some sort of return on our investment, whether it be through interest, dividends, or appreciation on our investments. Take a look at what's happened over time with inflation. Unfortunately, as inflation goes up, so too does interest rates. Now, of course, as a retiree, we want interest rates to be higher because we can get higher return on our investment. But what about if we're not retired yet? Unfortunately, a rising interest rate environment not only will decrease the value of our fixed income investments like bonds, but it can also decrease the value of our lump sum pension plan on many defined benefit pensions of the companies that we specialize and work with the employees of. Now, bonds and lump sum pensions work very similar, at least defined benefit pension plans, in that if we see a 1% increase in interest rates in the future, you could expect roughly a 10% drop in your lump sum pension. Same thing with long-term bonds. If we have a large portion of our retirement portfolio in fixed income investments like long-term bonds, there's going to be a pretty significant drop in the value of those bonds during that increasing interest rate environment. So what's unique about today's environment is that interest rates have hit historical lows just in the last couple weeks. Now, while this is expansionary policy or attempt at stimulating the economy in the short run, eventually those interest rates will likely go up, and what's going to happen is it will be reducing the value of our bond portfolio, and like in the instance of right now, our stock portfolio is also very low, potentially if we have been too aggressive with our investments. So hopefully there's somewhere in the portfolio where you have some type of safe investments that aren't reliant on the equity markets or interest rate markets, such as cash or guaranteed investments like CDs or potentially fixed annuities. Here's the effect of inflation over time. You see with a portfolio where the rate of return is 5% that year. In a 3% inflation environment, the real return on that portfolio is only 1.9%. So the growth on our purchasing power was not even 2% in that instance. Now, what if we got a 0% rate of return? Well, we actually lost close to 3% in value of our portfolio. And how about a declining market? A negative 5% rate of return on our money actually results in a negative 7.7% return on the value of our portfolio. Think about if you have a pension annuity or some kind of a fixed income stream that is not growing over time with cost of living increases. A $2,000 pension annuity after 1 year becomes worth, in terms of real purchasing power, only $1,940 per month. After 9 years, that $2,000 a month pension is only going to feel like closer to $1,567 per month. So it's important that we hedge against inflation, and one of the ways we do that is through equity investments. And we're going to talk about how the retirement group invests in equities as a portion of our retirees' portfolio, understanding that everybody's different in terms of their cash flow need, their risk tolerance, what investments are likely going to be appropriate for that individual. Tonight, we're going to talk about big picture, how we approach these topics with our clients, but understanding it's probably a good idea to schedule a meeting with somebody to give them your feedback on what your comfort level is with investments, what your cash flow need is throughout your retirement, or if you're not retired yet, what you anticipate your cash flow need to be once you get there, and any predispositions for or against different investments so that we can put a proposal together for you and give you some feedback or some considerations that'll hopefully get you in the right direction to where you need to be with your investment portfolio to produce the cash flow that you need through retirement. So what are these two investment strategies we employ? One of them is modern portfolio theory. And modern portfolio theory is deliberate diversification. So that's not having all your eggs in one basket, as it were. Buying different asset classes that don't always move together, so that when our stocks are down, maybe we have bonds that haven't lost as much value, and that's where we can produce cash flow while we allow our stocks to recover. Or while our stocks are high, we can sell them and capitalize on our gains. Or when everything's down, maybe we have a cash position in the portfolio that will allow us to buy some time for our other assets to recover in value. This is based on buying assets that aren't fully correlated. So it could be international stocks as well as US stocks, or energy stocks and telecom stocks, as well as many other sectors potentially. Or having a cash position, maybe having some real estate, maybe having some hard assets. We're essentially trying to have lots of different areas that we can draw from so that we have options whenever some of our asset classes are down, like many of the asset classes are currently down in value. Margin of safety, on the other hand, has to do with the behavioral theory of finance, which is avoiding permanent loss of capital or losing our money. Now, we may have our stocks being down in price right now, but that doesn't necessarily mean that they are as far down in value as they are in price. We saw the Dow Jones lose close to 30% in value in the last 4 weeks alone. Now, does that mean that the companies that make up the Dow Jones on average will all lost 30%? Maybe, but probably not. And one of the reasons that a lot of companies will lose price or have their price drop more than their value is because of emotions in the market and the overreaction to media and to a lot of the noise that's out there when we read articles and turn on the news that sometimes have us relying on our emotions, such as fear and greed. Right now, there's a lot of fear in the market. And what margin of safety tells us is that the two aren't always correlated, price and value. So Sometimes we can have prices that are higher than the true intrinsic value of a company. And sometimes, like potentially right now, we can have prices that are lower than the true intrinsic value, which of course we would not want to sell those assets if they're priced lower than value. And if the price is higher than value, maybe what we want to consider selling them and moving into an asset that is a better bargain or more appropriately priced. Now, this makes it a little more difficult to invest money because we have to actually look at the fundamentals of a company. We have to look at the balance sheet of the company, how much they own versus how much they owe. We look at the income statement of the company, how much revenue a company is producing versus their expenses, and also the cash flow to make sure that they don't get in a bind for paying their bills. We also like to look at the yield of the company, which for a stock is a dividend. The yield for a bond would be its interest payment or coupon, and the yield for an asset like real estate would be the rents that that particular investment property pays on an ongoing basis. So those things do change. Dividends can get cut, unfortunately. Coupons of bonds will stay fixed unless the issuer of the bond goes into default. And of course, in real estate, we know that there are vacancies from time to time that can change our expected revenue from that particular investment or expected cash flow, which is very important in a retirement portfolio. Now, in modern portfolio theory, we're essentially looking to diversify. So rule number one, reduce volatility. Rule number two, read rule number one. That is all we are trying to do with modern portfolio theory is by spreading assets out, we will smooth the growth pattern over time and have less swings or volatility in the portfolio. Unfortunately, reducing volatility does not in and of itself reduce the risk of the portfolio or risk of losing our money or permanent loss of capital as we define it. So an example of this would be the last couple down markets we had in 2008, real estate markets collapse. We had a global banking crisis. In 2000, we had the dot-com bubble bursting. These are two instances where it didn't matter how well you were diversified. You could have stocks and bonds. You could have stocks from all over the world. You could have stocks in different sectors. And what a lot of people that were invested in index funds, where your money is spread out across a wide array of sectors and asset classes, they all still lost money. Now, the one asset class that didn't lose money, well, at least to inflation, was cash. And so that's one recommendation we have to a lot of our clients is to hold cash positions or evaluate the cash position on an ongoing basis. And that's one of the benefits of the cash position that we currently hold is we may be able to put some of that cash back to work in the near future and take advantage of some of the bargains that exist today as a result of uncertainty in the market and declining prices of the stocks that we own. One of our favorite value investors is a man named Warren Buffett, who is one of the owners, primary owners, founders, and managers in Berkshire Hathaway, a stock that has substantially outperformed the overall market for a very long time on average. Now, the stock doesn't outperform the market every single year, but on average, it has done a very good job of doing so. And we always look to managers with a very good track record for insights in markets like this one. And one quote that we happen to love at the Retirement Group is diversification is protection against ignorance. It makes little sense if you know what you're doing. Those are strong words from a man who has a very good track record for close to 60 years now. He's basically saying that by over diversifying in our portfolio, we're essentially buying the good with the bad or buying the expensive with the cheap. And what managers like Warren Buffett, value managers, would prefer to do is to diversify into inexpensive asset classes. So make sure we have many different asset classes to smooth the growth of the portfolio, but to not diversify just to diversify. In other words, be more selective with the companies that we're buying in an effort to protect against permanent loss of capital by buying with a margin of safety. So what is margin of safety? Margin of safety is essentially like when we go to the grocery store, we like to pad our bank accounts by always finding good deals. Same thing with stock investing. When we're going to look at what a company is worth, we're going to evaluate the company, we're going to see what assets the company owns, how their revenue and profits have been, how the management of the company is, and we're going to come up with a price of what we think is a true intrinsic value of that company. And then we go to the market and say, well, what does the rest of the market, this general consensus, say that the value of that company is? And the two might not always match up. And normally, true intrinsic value does not sway nearly as much as the actual price of a company. And you can see here from this graph, we may find that the true intrinsic value is somewhere around $15 a share for stock, but the market price could be as low as $5 a share. So we've just found a margin of safety of $10 per share for that particular stock. That gives us two advantages. Number one, there's more upside potential in that stock, as over time, price of a stock will meet its true intrinsic value. We just have to have patience in many instances for that to happen. But it also protects from the downside. And that's even more important when we're looking at a retirement portfolio, is if we buy with a margin of safety, we will have better protection against uncertainties of the future. So the uncertainties with something like a pandemic or a health scare, uncertainties with political risk going forward, uncertainties with interest rates, uncertainties with a company. We could have a company that had great prospects, great assets, great revenue, good management, and all of a sudden something that we couldn't have predicted changes, such as legislation that made it difficult for that company to do business. Well, if we bought with a margin of safety, we actually have a little bit of a buffer to prevent those types of things from affecting our portfolio. So maybe our company's true intrinsic value dropped by $5, but because we bought it at a $10 margin of safety, we had a little bit of wiggle room there to protect against that uncertainty. Behavioral finance is the study of the inconsistencies with our decision making and our money based on our emotions or our psychology, behavioral characteristics. What we found is that if we can understand our emotions better, we can better understand the best day to retire. Oftentimes it's very uncomfortable to retire when markets are declining and we anticipate future job losses and interest rates are low. Turns out oftentimes that's the best time to retire. When markets are low, everything is less expensive, better time to invest a lump sum of money, and potentially a good time to invest any other cash that we have available to do so. When interest rates are low, like we talked about earlier, great time to take a lump sum because lump sums are much higher. Not to say that that's appropriate for everybody. In many cases, we'll recommend that we take or have our client take the annuity option on their pension for a variety of different reasons that we talk about in our pension white papers, as well as our pension seminar and pension webinar, but webinar as well as this one. We want to prepare to make investment changes when prices change, whether up or down. So in the most recent case, a very drastic change to the market in a very short period of time couldn't be a better time to reevaluate your portfolio. And as painful as it is to see these losses on paper, those losses are just paper losses until we actually sell. And what our emotions oftentimes will drive us and many of our clients to do is to sell at the worst time possible, sell after we've lost value, rather than having patience to understand that this too shall pass. It just might take some time. We also can't have all of our money in the stock market, or in many cases shouldn't have all of our money in the stock market, for somebody who's retired especially. And what that allows us to do is, by having cash positions or asset classes other than stocks, we might actually recommend somebody become more aggressive when in their own mind it might be an uncomfortable time to do so, but that's when the most bargains exist, is when everybody is the most uncomfortable because of recent declines in markets. But that's where the most bargains exist. We'll also develop a better retirement strategy and try not to sell when markets go down. Now, that might not mean we don't want to sell something when it lost price, because there's a difference between something that's cheap and something that's on sale. The difference is the true value of that company. So because something went down in price, that might not necessarily mean that we want to buy it. In fact, we may want to sell it if we think that its value went down even further than its price. But we have to evaluate that on an ongoing basis And that's something that we work with our clients to do periodically, especially in these types of times. As you can imagine, we have been taking a lot of phone calls in these last few weeks, and that's exactly what our job is to make sure our clients are making good decisions with their money long term and not just what's most comfortable in the short term. We want to mentally prepare to buy when we're uncomfortable, and we've been preparing for this last month for close to the last 10 years with our clients. We knew it was coming. We just didn't know when and how severe it would be, but it's inevitable. In fact, it's likely that you may see several markets like the one that we're in right now throughout your retirement. So it's important to expect them and be ready to take advantage of them potentially when they come around. And also understand permanent loss of capital versus volatility. So trying not to panic when markets are down, understanding that stocks go up on average over time. And if we buy good stocks and have a well-diversified portfolio, chances are our stocks are going to recover and continue to be the growth engine of our retirement portfolio so that we don't run out of money. One reason that people do run out of money is not only by selling their stocks at the wrong time, but by taking too long to get back into the market, an instance that we call market timing, something that we do not recommend, especially for a novice investor. But by understanding that stocks on average do go up over time, by understanding that our primary objective, not just as advisors, but also as investors, is to avoid permanent loss of capital, which could be an instance of panicking when markets are down, could also be an instance of taking too much risk and not having the liquidity needed to weather the storm or to buy some time to allow markets to recover. But it all comes back to the investments that we're buying. And there's a difference between an investment that goes down in price and then an investment that permanently loses the value of its capital. Understanding our emotions, we can try to do what is very difficult for the average investor to do, which is to buy when we have bargains and sell when something is expensive or at a premium. Our emotions drive the opposite strategy in our mind, because normally we're not comfortable buying something until we see it increasing in value and becoming a little bit more promising, or at least in what people are telling us the future prospects have. And normally we are very apt to sell something after it loses value and we can't get as good of a price for it. As we all know, the opposite is the best strategy in long term, is to buy at a good price or at a low price and sell for an even better price or a higher price. Avoid the biggest mistakes, and this is where people have themselves in an instance where they are running out of money or having to go back to work in retirement, which for us at the Retirement Group is the absolute worst case scenario. So part of our job is to help people avoid those expensive mistakes and take advantage of bargains when they exist. And there's certainly some existing in today's market. We just have to make sure we can differentiate between a bargain and a cheap company. Going back to Warren Buffett, one of our favorite managers, one of the students of the father of value investing, Benjamin Graham, another good quote: "Be fearful when others are greedy, and be greedy when others are fearful." Right now, there's a lot of fear in the market. And what Warren Buffett has consistently done that we found is one of the reasons he has such a good track record that he has had and his company has had is to be greedy when there's fear in the market. And when there wasn't a lot of fear in the market, about a year ago, we had a very good year in the market. Everybody was feeling good about their returns on their investments. And many of our clients were wanting to get more aggressive because their expectations were higher on returns. And sometimes our job in those areas is to talk them down from taking that extra risk that's required to have additional returns, so that we're not in an instance where they took too much risk in a time that was potentially the worst time possible, right before the top of the market potentially. Berkshire Hathaway stock, here's an example of what one value manager in Warren Buffett has had the ability to do. You see the red line that is near the x-axis. That's actually what the S&P 500 has done. This graph goes from 1980 to 2015. If you invested in the S&P 500 and stayed invested throughout that entire time, you would not be disappointed with your investment returns, is my guess. you would have had a very reasonable rate of return, probably somewhere around close to 10% potentially, including dividends. If you invested in Berkshire Hathaway stock during that same time frame, you would have had substantially higher returns. It would be closer to 70,000% return. Now, of course, there's no guarantees that that will continue, and past performance cannot be indicative of future results. But we see a lot of similarities with value managers in their ability to outperform indices or the average stock market over long periods of time. You'll see some times in there, like the last couple of years, as well as in 2007, there's underperformance occasionally with value managers. But what we found is that if we can find good managers who choose good investments and keep the fees low, is another big part of the consideration that we're making, we're going to be satisfied with our investment results long term. We just may have bumpier roads from time to time like we see right now. Here's another company that has been in the portfolio of Berkshire Hathaway for quite some time, one of many, that had a 50 times return. In other words, $1 became $50, and this is in a 15-year period. Not too bad for one particular investment. Another good quote from Warren Buffett is that his favorite time horizon is forever. So he buys companies with the expectation that it'll hold them forever, but consistently evaluating them to make sure that they are still a good investment for his investors and his owners of his company. So through this value philosophy, what we've talked about in summary, buy solid companies below intrinsic value. We look at valuations, which are metrics such as price to book ratio, price to earnings ratio, price to cash flow. And we do like dividends, although it's not prerequisite for a company. As many of you know, Berkshire Hathaway has never paid a dividend. We like to identify great money managers, and we have 8 tenets through which we look at to make sure that our managers are still consistent with what we think is a good manager for the equity portion of our retirement portfolios for our clients. And we want to make sure that we're first and foremost understanding the probability of permanent loss of capital. We buy investments, of course, to grow our money, but more importantly, to not lose money. That's what value investors agree on is the best way to make money in investments is to just not lose money with their investments. So with that, we're going to wrap it up here, but here's some ways that you can capitalize on today's opportunity. First, take advantage of price volatilities, and if you'd like us to do a complimentary 401k review for you, we're happy to do that. We can also do an NUA analysis. If you're somebody that has appreciated company stock, this could be a good time to consider that and update your analysis. And we can also offer a complimentary cash flow analysis if you're not retired yet, or even if you are retired, to make sure that you're still on track with your investments and start to back into what investments will likely be appropriate to produce that cash flow long term. Make sure that we don't get caught up in the herd behavior. Turns out that the herd on average is wrong when it comes to investments, and that's because our psychology tells us to buy high and sell low, unfortunately. Try to be patient instead of greedy, and find managers that hold cash positions so they can redeploy those cash assets back when there's better bargains available, like we think that there are definitely today. Let us know how we can help, and make sure that we're understanding the goals whenever we're investing money so that we can understand what's appropriate for you, might not be appropriate for your coworker or your friend, but we need to get to know you well before we actually recommend investments. Even Berkshire Hathaway stock, we talked about Warren Buffett as a manager, but we're not recommending you buy that stock until we actually have an understanding of what your goals are. You could be somebody that you only need to have cash flow that's related to investment returns of 2% per year. So you probably wouldn't even have to have stocks in your portfolio if that was the case. But we'd have to get to know you a little bit better before we made that recommendation. Let us know if you'd like to set up an appointment. It could be a phone call, web meeting, especially with the social distancing that we're going through in this next couple weeks, it looks like. And favorite quote was actually the predecessor and mentor to Warren Buffett and the father of value investing, Benjamin Graham. In the short run, market is a voting machine, tallying up which firms are popular and unpopular. But in the long run, the market is a weighing machine, assessing the true substance of a company. Food for thought. We hope you got some value out of today's call. Let us know how we can help, folks. Our phone number here at the office is 800-900-5867. You can reach us at theretirementgroup.com or read our blogs that we consistently update at blog.theretirementgroup.com. Thanks, everybody. Have a great rest of your evening, and we hope to hear from you soon.